Good afternoon, guys, and welcome to this Futures Trading Performance Pursuit, a little bit of a webinar we're going to do. It's Sunday the 24th of September. I'm really excited about today, and I'll tell you why. What we're going to talk about in today's trade strategy is going to be predominantly focused on pretty much the pros and cons, or perceived cons, of utilizing a price ladder. Now, the reason I want to focus on this is because I've had quite a lot of questions over the past week about, making that transition from, the traditional spread betting accounts, the IG indexes, the Saxo banks, making that transition across to, executing on, the price ladder. And what I'm going to do is I'm going to just dispel a couple of those truths, show you some of the really key, advantages of executing on the price ladder. What we're going to then do, talk a little bit about some of the focus points from last week. Hopefully I can sort of share what the traders were what the traders were talking about last week on the floor, where we were looking, where our attention is. It's so crucial if you ever want to see or enhance your performance. Ultimately, just look what professional traders are doing. Okay, that's ultimately they're focusing on certain things for a reason. It's because there's edge, there is opportunity. So we'll talk a little bit about that. Then we're going to focus on some of the points in the week ahead and finish off with my play of the week and the scoreboard from last week. Let's get straight into it then. So today's strategy is very simple. I'm going to explain it to you, and I'm going to hopefully I can get across why the price ladder is so key in executing ultimately, these various strategies. So what I want you to think of is in terms of when there's any central banks. Now, this past week, obviously, we had the Fed as well as the Swiss National Bank. In the previous week, we had the Bank of England, ECB. So within the last 2 weeks, we've had very key central banks, and they've given us very specific trade opportunities. Now, not only do we get central bank opportunities, we then get fundamental opportunities. Example, North Korea. With all that's going on in North Korea, we're getting a lot of noise around North Korea, and this creates fast money opportunities. We then have earnings releases. All right, a lot of you are stock traders, and you trade the big companies, you trade the earnings releases, and when they're missing, analyst forecasts, you get really fast moving markets. We then have economic data. Every single week we get a slew of various different pieces of economic data. Some of those data pieces the market is sensitive to, and some of them isn't. And then lastly, key breakout trades, where we have a sort of increase or a pickup in perceived volatility. Now, if you're looking at this list, you're probably saying to yourself, well, there's a common thing that goes on in all pretty much 5 of these types of edges. Okay, trading a central bank or a fundamental or earnings or economic data, these are all various types of edges. Now, the key characteristic with every one of these is speed of execution. In other words, fastest finger first. So what we can prepare for as traders is we can prepare the central banks. We can prepare our fundamental analysis, our earnings. We can prepare for all these events. But ultimately, we need to be able to execute as fast as possible. And this is, for us as professional traders, if you ever want to develop any one of these 5 edges, you have to do it on a price ladder. The simple reason is because you need best price, right? Particularly when trading a leveraged product. Don't forget, futures are leveraged products, right? You do need speed because every price, is leveraged ultimately. So every price matters. And I'll show you what that looks like a little bit. We're going to look through volatility in a minute when I show you, one of the previous Bank of England's. You'll get a feeling for what I mean when I say every tick matters and why the price ladder is so, specific. So the trade strategy is very simple. When we have and I'm going to kind of just exclude the breakout trade in this because you all know what a traditional breakout is. But when one of these other 4, when we have something that's not expected, in other words, the market is mispriced based on the information we receive. Right, a market needs to revalue itself very quickly. Now, because of that revaluation, so let's take, for example, that the current price is trading somewhere around here, and all of a sudden we get an earnings release, and let's take, for instance, Apple comes out and Apple tells us they're going to miss their expected earnings due to a slowdown in iPhone sales. Now, all of a sudden at this price point we have a number of positions. Okay, we could have some shorts, we could have some longs. Ultimately, however, the market needs to reprice itself down to this point. Okay, now when the moment comes, bang, it hits the wires. Smart money, in other words, big institutions and all that, they don't know where fair value is. In other words, they cannot calculate within a matter of split seconds where fair value should be. However, anyone with positions knows fine well what the market's likely reaction to be, and that's why we get that initial very aggressive down move. Okay, the market tries to reprice itself simply because people just either get out of positions, just get out of risk, okay, or we get fresh positions entered on the back of that. The market then obviously tends to move a little bit sideways, and then if fair value based on the new information is lower, the market will ultimately move to that price point and then begin to settle sideways. Okay, the key that we're going to look at today is this meaty bit. We want to take a look at what does that repricing look like? What are the various opportunities that we can use and watch and learn from when we get this repricing? And ultimately, how can we use the ladder to develop strategy? And that's what this is about, guys. This isn't just me pulling out strategy. I'm going to show you what the strategy looks like on the ladder, and hopefully you can take that, replicate it when you get central banks, when you get new fundamentals, when you get earnings releases, as well as key economic data. Okay, one person says they're not getting sound. Can anyone confirm they're also not getting sound? As far as I can see, everything is good, loud and clear. So if I can just get a couple of hearts or a thumbs up, just that the sound is good going forward, yeah. Is everything okay with the sound, guys? Cool. All right, thank you for that. Okay, so let's move on. So that's the basic trade strategy. Now, what I want to talk about is the context. Okay, so I'm going to paint the picture for you. You need to cast your mind back to the 3rd of August. Okay, so we're not going to deal with the September meeting. Again, I could have dealt with that, but I'd rather deal with where I have a little bit more of a simpler fundamental, so I don't have to explain it too much. Okay, so it's very simple. The Bank of England voted to keep rates at 6.2. Now, going into this Bank of England meeting on the 3rd of August, there was an expectation that Andy Haldane, one of the members, was going to vote, and we were ultimately going to see a 5-3 in favor of no hike. So still no hike, but one more member, the chief economist, was going to vote for a rate hike. Now, we knew that expectation was in the market given that he had come out in a previous statement and he had said the time for higher rates is coming closer. Okay, so he had turned very, very hawkish, and all of a sudden the market went into this meeting expecting Andy Haldane to potentially shift his vote. Okay, so there was what we call a hawkish slant, or a hawkish bit of pricing going into this meeting. Now, I'm going to show you why it's key to, you can't just execute, you also need to know what the market's positioning is, and I'll show you why in a minute when we execute on the price ladder. Okay. Let's talk a little bit of structure. So obviously when Axia is preparing for our central banks, we obviously do all the fundamental analysis. So we know where the key pinch points are, what are the key phrases to look at in the statement, and what are the key things we're focusing on. But then second to that, we then go and discuss trade structure. So we go and look at the sensitive markets. In this instance, obviously, we had some traders focusing on the GBP versus the dollar, and we had some traders focusing on the UK gilts. Why? Because they are most sensitive to any UK central bank decisions. Okay, so those are the two markets we're focusing on. Now, for us as traders, one of the best things to look at, to lean on with structure, is a market profile. And I'll show you why. And this is a beautiful example of when a market has really strong structure. Okay, so each one of these obviously depicts a daily candle. I'm not going to go through this with you. But what you can ultimately see if we come back to this very first day type, day one, is we can see a double distribution. Now, if you've gone through the market profiling course, that Axia's offers, this is a very specific strategy that we teach all of our members. And ultimately, what this strategy tells us is that when we have a double distribution, we've got natural long positioning in the market. In other words, this set of single prints here is showing us there are longs in the market. Right? That is then confirmed. In other words, the longs are confirmed when we hold on to this high low and we hold on to it for a second day. So for 2 days, the buyers are not only sitting on side, but they do actually make further ground towards the upside. Okay, so we know going into this meeting, not only is there a hawkish bit of pricing going into the central bank, but there is also structure in this market. So what we would look at is, if we had seen a 5-3, we would have expected this market to take out this double top and the buyers to be even further on side by the end of the day. However, if they did not come out hawkish, that would give us a fantastic technical structure to lean on, because we can see that there's not only a key double bottom here, but there's also a lot of buyers that would need to liquidate longs in the event we took out this area of 132.12. So make a note of that 132.12. I'm going to show you that price on the ladder, and we're also just going to watch what the market reaction was once below that price. Note, if you did want to know technically what the trade strategy is in terms of a double distribution, we're looking to target the other side of this distribution. So somewhere in and around here, we would have been looking to short and target back down towards the 131.75 or 70 mark. Okay, so that's the basic premise of trade structure. Now, what we're going to do is we're going to go through this trade strategy. I'm going to show you the execution. Again, like I said to you last week, this is the Trading Technologies platform. You will see me execute on the Trading Technologies platform every single week. This is the platform that the Axia traders use to execute for good reason. Okay, now what I'm going to show you on the ladder is first I'm going to show you the initial fast money execution. Okay, remember what I said to you. Today I'm hoping to convince you as to what are the real advantages of executing on the price ladder versus maybe what you're utilizing at the moment. Okay, so the first thing is the initial fast money execution. Remember what I said to you? We're expecting a 6.2 and we get a 5.3. We're expecting a 5.3, because of the pricing, and we ultimately get a 6.2. I'm then going to show you what absorption looks like. Okay, I'm also going to show you then what the break of the 132.12 will look like, as well as the first key retracement. Now, one of the key things to a fundamental shift, or when we need a market to reprice, is we initially get the first down move, which is the reprice. We then get the first pullback, and those first pullbacks, I say to any of our new traders, our young traders, particularly on our career program at the moment, those are what we like to think as easy trade opportunities, because when there's a repricing, that first pullback is always going to offer you a relatively easy short to target at least a retest of the lows, if not an extension. Okay, so if you do miss the initial move, or you don't feel comfortable executing on the initial move because you're trying to interpret the information, that is perfectly fine. But don't miss out on the second opportunity. And I'm going to show you how to get involved in that second opportunity, again, utilizing the price ladder and ultimately absorption. Okay, and then the last thing is just looking at the extension, continuation, and correlation between the pound and the gilt market. Okay, like I said, 3rd of August, this is the GBP USD futures FX. Okay, so what you can see in front of you is the price ladders. Now, the first the ladder on the left, okay, if you can see these ladders on the left, doesn't look like there's much price going on there. Those are short stir markets. Okay, so they're the most sensitive to interest rate changes. Okay, we then have the pound versus the dollar, and next to that we've got the gilt 10-year market. Okay, so those are our 3 focus markets. That's where we're going to pay attention to, and we're going to look at the execution predominantly on the middle of the two, which is the pound versus the dollar. So first thing to note before I push play, notice how thin the market is. Okay, so we've got relatively low liquidity. Now, this is, straight away, this is probably the first most beneficial thing, is that you cannot see, if you do not have a price ladder, you cannot see how liquid or illiquid a market is. Okay, and liquidity is massive, and I'll tell you why. Let's say I was to come into this market now and sell, say, 20 contracts. Okay, I'm going to get filled over, say, 5 or 6 prices. So you can imagine that, for relatively big traders, and there's a couple of them at Axia that might put, 50 or 100 cable into the market, they have to consider the execution methodology because of how thin it is. Okay, so the first major advantage we can see is we can see how the market thins out, or the lack of liquidity. Now, let's play it, and I'm going to tell you when the number comes out as well as when the execution goes through. Okay, so the first thing to pay attention to is we can see, if I just go back a couple of seconds there, okay, note first up, okay, which side of the market is this trader leaning on? We can see he's leaning on the bid side. Okay, why is that? Because the expectation today is for a potential shift to 5.3. Okay, so we can already see that this trader's decided that there's a lot more upside potential in the event of a hawkish surprise of a 5-3. Therefore, he would rather choose a side. So he'd pick a side so that if it comes out in his favor, bang, he's getting best price execution. If it doesn't, well, he can still execute on the other side, but he may be missing best price execution. Okay, so already one of the major positives on the price ladder is that ultimately it's one-click execution. Okay, the minute you click, you're in. You're getting whatever price you're clicking on. Okay, let's play it forward now and see once the result comes out. So bang, the news is out. Okay, the market has been told that it is a 6-2, so not quite as expected. So we can see straight away, had we been trading or offering on the right side, we would have executed somewhere around the 132.34 mark. Now, keep in the back of your mind, every single tick here is roughly speaking $8 to $10. Okay, so every single price increment is let's call it $10 for ease of sake. Now, this is, the first thing you got to see is with the speed at which the market is moving, you cannot afford to sacrifice even one tick with the choice of software you're using. Okay, and this is crucial because every single price here, if it's $10 on the smallest increment, which is a 1 lot, if you're multiplying that by 5 or 10 lots, you're talking about, $50 or $100 for every single price. Okay, and this is why professional traders use the price there, because we are so price sensitive. We want the exact price because we are trading a leverage product. Let's play on and see what happens. Okay, so we can see, remember our first thing we said is we spoke about the 132.12 area. Keep that in the back of your mind as we go through over that video. That was the key breakdown point. Okay, so we can see the market started at 35s, traded down to 6 through those 12s. Let's see what's happening now. And the first thing I want to point your attention to is look at the volume being executed on the right here. Okay, watch what happens over the next couple of seconds. You can see we got 55, 62, 43, and 113. Watch what happens now. Okay, so the market offers bid, offer, bid, offer, bid, and let's pause there for a second. What's just happened all of a sudden? Okay, notice what's happened. We're starting to see some really aggressive absorption taking place between 12 and 17. Okay, now I know what you're going to say. Wow, this is very quick and I can't quite keep up with it. But this is where pattern recognition and recording your screens is so crucial, because if you go and watch back a lot of earning releases, data releases, fundamental central banks, you're going to notice that this pattern exists all the time. Okay, which is that the market is being absorbed before it ultimately moves again. So let's keep playing. And we can see the market comes back, and we can see suddenly an extension. Now I'm going to push pause there one last time because I want to show you what that absorption looks like now that we've moved to lower prices. Okay, so you can see from price point number 11 all the way up to 17, we've almost transacted 1,200 or even maybe 1,500 contracts in a space of 5 prices. Okay, so quite a lot of absorption there, and suddenly, bang, the market releases from 12s to 90s. Now, bear in mind, guys, that's a very quick 22 prices that you've taken out of the market. Okay, you didn't have to do anything too smart. You didn't have to have the best price. In other words, you didn't have to sell 32s. You could have merely executed on the absorption around the 12s. Let's play on. Okay, remember the key level, 132.12s. If we come back there, don't forget how important it is. Equally, don't forget the 131.70 area that we're talking about in terms of the target. Okay, so what can we see here? So we can see quite a lot of two-way trade, and the market is now trying to bounce. So we've come off the 86s and the market is trying to bounce. Now remember what I said, the key to the strategy is to ensure if you miss the first movement, don't miss the second movement. And the second movement, we're going to enter again when we see that sell side absorption. Now don't forget the 132.12s, very key area. Let's watch what happens now when this market fully retraces. So we stop around the 4s and we start to offer again. We come back up to the 4s. 5 trades, 6 trades, 7 trades, 8 trades, 9 trades, 10 trades, 11 trades. Okay, so we trade all the way up to the 11s once. The market goes offer down to 5s. We come up a second time, trade to 9s. The market then offers a second time. We come up a third time. Okay, the market starts to, I'm just going to move this back a little bit. The market comes back up to the 3, 4, 5, 6. Okay, so what can we see here? Bang, it came up to the 11s first time. It then came up to the 9s the second time. It then came up to the 7s the third time. Okay, we can see that ultimately someone absorbed the 11s, then the 9s, then the 7s. So he's absorbing lower and lower prices. Okay, we come up again to the 10s. Remember our key level, 132.12. And what can we see on the right side here? Again, we're seeing a lot of absorption. Let me go back 5 seconds and you can see that very clearly. Okay, notice what's trading at 132.10 here. I'm going to read it out for you. At 9, we've got 80 lots traded. At 10, we've got 225. At 11, 207. Let's fast forward that and see what happens. Okay, so at 9, we've now got 115. At 10, we've now got 262. Okay, at 10, suddenly we've got 306. At 9s, we've got 200. At 8s, we've got 255. So all of a sudden, in a space there of almost 3 or 4 seconds, we've just seen 250 contracts being absorbed at 9 and 10. Okay, and that's the key, guys. That's the absorption just in front of that key level of 132.12. Let's play it on and see what happens now. Okay, so the market's now held on to those 12s, it's held on to that key break point. That is our first retrace, and that is the ultimate absorption. And it happens very, very quickly, but you will learn to interpret these patterns through watching the ladder time and time again. Okay, ultimately we can see now the market starts to offer a little bit. We can see that the seller has absorbed quite a lot at 8, 9, 10, 11, and we can see now he's starting to execute a little bit toward the market. Okay, so we're coming back up towards the 6s, up towards the 7s. I'm just going to move this on a little bit so we can get back onto the key break point. Okay, so we can see now we're starting to make lower prices. We are still seeing the absorption. Again, note now what we've done here. Between 20s and 10s, we've taken almost a good 4,000 or 5,000 contracts. Okay, remember what I said. When we get fundamental shifts or value shifts, the first pullback, it's highly likely to at least retest the previous low and potentially extend. Okay, so the highest probability, we're talking 80, 90, 95% of the time, you're going to at least retest the previous low and maybe even extend. Okay, ultimately we'd like an extension, but if it doesn't extend, we have to be cautious to take profits. Okay, so we can see the market's come down to 86s. Don't forget that key area we're talking about, our target, which is around the 70s. Ultimately, that would be the end of the double distribution. I'm just going to move this on a little bit so we can have a look at the break point. So we come to the 6s, market trades the 5s, and again, note here, one of the very key trade strategies you can do if you're still not in this trade is you can actually be quite aggressive looking to sell these 84s as the market then continues the trend. And you'll see that once the 84s trade, you get quite a strong little offer down towards those 70s, and ultimately we then finish off the trade strategy. Okay, so the 82s trades, 81 trades, 80 trades, 79 trades, and ultimately we get a little bit of a flush of stops, a little bit of absorption at the low, and that was key, guys. Okay, remember what I always teach, we always say this to our members every single time we do a strategy session with them. We always say to them, be observant, okay? If the market is coming down quite aggressively, as you can see, what we don't want to see if we're short is we don't want to see someone buying it, okay? And you'll notice if you look here, 5, 6, 7, and 8, what have we got? Someone just bought 600 contracts, okay? To put that into perspective, that's quite a lot of volume that someone was willing to accept at the low of the day. And surprise, surprise, what does the market ultimately do? It ultimately holds on to this area, 75s, goes back up the page, and ultimately starts to move sideways. Okay, so you've seen absorption, bang, not just on the first release. We saw absorption again on the first pullback. And then we saw quite a lot of absorption when we made this low. So 3 types of absorption, all in the same trade strategy ultimately. Okay, and that's the key to the price ladder. It allows us to interpret information in real time. Okay. Ultimately, the cable did move a little bit lower. It ultimately eventually fell down to that key profile strategy I mentioned to in the beginning, and that is the end of the trade strategy. Okay, now, what I want to talk about now going forward is you can obviously take a snapshot of this, guys. You can go have a look at this data. If you've got the the price ladder, you can go watch that back over. What I would suggest to you, a lot of people are going to say to me, yes, where can they go and watch this over again? What I'm going to say to you is start recording your price ladder. Okay, what you can do, it's relatively so cheap now. The Trading Technologies platform is almost free, guys. I don't like the word free, but it is almost free. It's so much cheaper now to execute off a price ladder. So go get yourself, even if it's just a simulated version, get yourself on the price ladder. Start learning these various strategies and start recording those ladders. That's the real clue. Remember, this is a pursuit, a performance pursuit stream, and that's what it's all about. And that's why I want you guys to start recording. As we obviously say to our members every single day, make sure you're recording these key events so you can learn the various nuances of your strategies. Okay. Now, what were we focused on this week? Well, firstly, we were focused on the Swiss National Bank, and for good reason, and I'll tell you why. Okay, we've got two major central banks that are still overly dovish in a sense. Okay, one is the SNB and the other one is the BOJ. Now, the BOJ and the SNB are particularly crucial because traditionally they have been seen as carry trade central banks. In other words, you borrow in a central bank that's going to remain dovish forever, and you then invest or lend or margin or whatever it may be, utilize that money where you can get higher yield, higher return. Now, one of the big arguments for a long time has been that because there's still a lot of central banks that are relatively dovish, we still remain in a global environment of relatively easy monetary policy stances. Okay, sorry guys, I can see you asking questions. Thank you for the questions. What I suggest is let's hold them off to the end, and then I'll answer all your questions just so I can get through the stream, and I will answer your questions at the end, so just ask it again at the end. Okay, so the key with this now is that we're focusing on the Swiss National Bank because potentially the day that we get the shift from these major global players, that could be the potential day when we start to see the volatility and the volumes and flows come back into the market. Why? Because those are major fundamental shifts where fund managers' portfolios need to be very quickly adjusted. Okay. We obviously then focused on the Fed and we did a, if you go onto the members website, you can go watch the rundown that we did for the Fed. We covered the pricing, the analysis, all the various elements of it. And we had a really good session. I think one of the key highlights was that, the market wasn't expecting another hike this year. But if the dot for 2017 had remained as is, and they still indicated, the third hike for this year, then we would be quite aggressive playing the hawkish play, particularly in the US bonds and the gold market. And if you go look at the gold and the US bonds, there were some fantastic opportunities there. So a lot of our members were really grateful that they managed to not just be able to understand the Fed a lot better, but also execute their strategies with confidence. Now, one of the key things and one of the takeaways one of our members said to us this week, and I know a lot of our members are listening today, was we ran our central bank rundown about 2 hours before the meeting, and one of the key things that came through was, can we maybe do it a day before? I'm pleased to let you guys know we have shifted it to the day before. All our central bank meetings now will happen 24 hours before, and then the next day we're going to spend talking a little bit about strategy. Okay, so again, it's so important. If you're not an Axia member, the portal and the streams are there for you guys. Okay, so if you have suggestions, if you have feedback, let us know and we'll adjust accordingly. Okay. Then there was a lot of attention being paid to this oil positional breakout. It was our sort of, my trade of the week last week. We'll talk a little bit about that in a minute. There was a lot of focus on that this week. There was a good break. There was potential, a good 20-25 ticks on side. But unfortunately, it didn't quite break and hold. Came all the way back, filled out, and then moved lower. So, for all intents and purposes, we did go nicely on side, but a lot of us ultimately stopped out, for pretty much a scratch. Didn't really feel any kind of risk on that. Why? Because it's a breakout trade. Okay, the very nature of a breakout trade is that once it breaks, you should not be going offside. Okay, that's the key to the strategy. And then obviously, I've been very vocal about this over Twitter. Apple stock collapse. I mentioned it 2.5 weeks ago, why I think Apple technically was a sell. And fundamentally, I mentioned last week in a stream why I thought it was a sell. We covered this quite extensively in one of the debriefs. And ultimately, again, it's just so amazing. We finally got the 5% reward, and this is what it's about, guys. It's not, I would never have thought Apple would have dropped 5% this week, okay? what I did think was that Apple was a sell, and I technically looked at it, I fundamentally looked at it, and I got short the stock. Now, the fact that it dropped 5% this week, thank you very much, and yeah, a little bit of luck and a great move, but ultimately, guys, that's what these streams are about. It's about preparing yourself, because every now and again the market's going to give you something nice. Okay, so those were our focus points at Axia last week. That's kind of where we were looking at, where the opportunity was. Now, in the week ahead, what we're looking at, again, massive number come on Thursday, I think Thursday or Friday, I think it's Friday actually. It's the European CPI. Okay, this is probably the single biggest number we have for the next couple of weeks, for good reason. Okay, firstly, obviously the bond markets are offering, yields are rising globally. The euro is kind of in a very sort of caught in a rock and a hard place right now, so it's looking for direction. We obviously have a lot of ECB members coming out and sort of almost saying, let's not get ahead of ourselves. We're not quite there yet on inflation. So again, this number's been particularly volatile the last couple of months. If that beats, okay, again, it's going to sound the alarm on the potential for a more hawkish ECB next month. Okay, one of the key meetings we have this week, Alex is back from Cyprus. He's obviously been in our Cyprus office, and Alex will be doing the mentor session this week. And I've always loved Alex's mentor sessions. Obviously he created the Axia price ladder course. So for all our members that have taken that course, do make sure you log on for that mentored session. Ask him questions. Okay, if there's any kind of strategy you're working on or developing, ask him those questions. He'll go through it with you in the live mentored session. So do make sure you join in for that live session. For those of you that are not Axia members, you can get a 2-week free trial. So, sign up that trial, just watch Alex in the classroom. He's absolutely brilliant, and will really sort of show you guys, some really good strategies on the price ladder. Okay, and then one of the things we're going to have a look at this week is Facebook Inc. And again, I know a lot of you are saying, but this is not a futures. When does he talk about equities? Now, it's so important, guys. A trade is a trade. A market is a market. It doesn't matter what market it is. Now, the reason I want to talk a little bit about Facebook Inc. is because, well, when the CEO, Mark Zuckerberg, comes out and says he's suddenly going to start selling millions of shares, well, of course you want to stand up and take notice, okay? Because one, he's a large seller, and yes, he says he's going to sell it over 18 months, all right? But at the moment, prices are quite elevated. All right, so for me, when a CEO is looking to sell prices or sell a market once it's done extremely excessive moves, I mean in excess of 35% this year, that's when you want to stand up and pay attention, okay? Because if he's going to start taking a little bit of profits, well, guess what? Maybe we're going to start to see a little bit more profit taking coming from other institutional players as well. Okay, so that's our focus points this week. We're looking obviously at Facebook, and as well as we're obviously going to focus on Apple in the week ahead. Okay, so very quickly, this was my play of last week. We spoke about the oil, the break of the daily inverse head and shoulders, and we spoke about potentially looking for a long around the 50-50 area. Now, what ultimately transpired, as you can see, we had a lot of dojis. So it's been a week of dojis in the oil. That's been the key takeaway. However, we're not quite out of this trade yet. We haven't given up on the oil trade yet. Yes, okay, we did stop out when we obviously, didn't quite get the breakout trade. So we stopped out of that for scratch or marginal loss. But what we're looking for is we're going to reignite that trade, take it on again. We're looking tomorrow very early on for the break of the inside day break. That would be my play of tomorrow. That would be the thing I'm focused on all day tomorrow. I'm focusing on that oil because it's got the potential for a really big $1, $2, $3, $4 move. Okay, but it's a matter of timing. It's a matter of commitment. Okay, and this is where the price ladder again is so key. I know what commitment looks like on the price ladder. So, there was a bout of it last week. There was on this up day where we took the stops above the 50.85, there was that commitment, but there wasn't that hold. Okay, commitment looks a little bit like this on the ladder. So the market quickly moves up, and the first little pullback is very shallow, but it's very jagged. We start to see a lot of two-way trade, but the market ultimately just cannot hold an offer. And eventually, those buyers become more aggressive, intentional, and then they start to move prices higher and higher up. Okay, so that's the play of last week, or my play of last week. Now, my play of this week is Apple, okay? It's not done yet, and I'll tell you why. Now, what we can see, obviously, when I spoke about this Apple trade, I was talking about the fact that this year, technically, we've only seen once where on a weekly candle we've closed below the previous week's low. And the following candle we sold off, or the following week we sold off quite aggressively. We'd only seen that once this year. I then noted the second time we'd seen it was the week prior to last week. And ultimately, technically, we got the continuation. Now, what I will say to you as a strategy, when you get a very aggressive down week like this, the probability to have an equal and opposite reversal is very, very low. Okay, it's extremely low. Why? Because the nature of this down move, I'm going to show you this on the daily chart. The nature of this down move means now that, yes, there can be people buying the stock. However, there are a lot of longs caught that are wanting to get out. Equally, there are a lot of shorts wanting to get in. So the natural tendency is that if it does start to rise and reverse, it's going to be slow anyways. Okay, so you get a lot of time to assess the nature of the buy if it starts to rise. So for me, I'm looking very closely around that 123.90, somewhere around there. I'm looking to add to the short position. Okay, we call this selling into a weak rally. That would be my play of the week in the Apple stock. Okay, so that's our scoreboard. As we can see, last week we took the long there, we took a scratch. Net result is we didn't make any money. Okay, we didn't make anything, we didn't lose anything, but we're not giving up on this trade yet. We're going to have a crack at that again early on tomorrow morning. That's going to be my play of the week tomorrow morning. I'm looking at that oil, and then I'm obviously looking at Apple Inc. over the course of the week. Any kind of a bid up somewhere around that 123.70, 90 area. I'm going to start looking for shorts. I'm going to try and get involved in the Apple stock. Okay guys, there's the information for you. If you're not a member of AxiaFutures.com, please log on, have a look. Get yourself a two-week free trial. If there's any questions, do email info@AxiaFutures. If there's a market that you feel you'd want us to trade, if there's a type of stream you think we could really benefit you, let us know in the info@AxiaFutures, because ultimately we want the product to be developed for you. Okay, obviously do follow the Axia Futures handle as well as the Axia Futures YouTube video, where we do daily video releases for you guys. Okay, now I'm going to start taking some questions and then we can ultimately finish off with this wonderful quote. So shoot those questions away, guys. I'm going to answer them. We've got 5 minutes, so let's get those questions in and let's take some questions. Okay, so everything was about price ladder today. I kind of hope you guys got the gist of the price ladder and why it's so much more advantageous to be executing on the price ladder. You've got to do yourself justice. You've got to move off of, maybe trading on the traditional platforms you used to, and just make sure you're executing where you can get best price, where you're not paying a spread, where you can manage positions so much more effectively. There's so many advantages to executing on the price ladder, and most important, and this is the one that hopefully you picked up, you can develop strategies just utilizing the price ladder. Okay, if you don't have a price ladder, you're never going to be able to develop any kind of trade strategies using the price ladder. Okay. No questions yet, so what I'm going to do is I'm just going to go through this quote. Ultimately, guys, okay, how much are the desk fees at Axia? Again, it depends which office. What you can do is you can log onto the website, it's all there for you. So yeah, it depends what office. We've got a couple of offices, so yeah, keep an eye on that. Sorry, did I say one? Yes, you're correct, 151. Let's quickly go back to that Apple. Did I write down? Oh, wrong number there. Apologies for that. Sorry guys, that's reading off my, I've got this on another axis. You are correct. It's around the 154. Yeah, don't quote me on that price. Apologies. Go and have a look at the chart. You'll see it. It's in and around that sort of break point. This is obviously taking, I've got the Amazon stock on the same axis. So it's obviously taking it off that. So yeah, you are correct. It's somewhere around the 154, somewhere there. Apologies. Thanks for that. Okay, desk fees in London, again, I'm not going to discuss desk fees. I think that's if you want more information, just email the info@AxiaFutures and we can give you more information about what the desk fees would be. Okay, anything guys, anything with regards to price ladder, any questions you want to know about the price ladder, about the execution, please do feel free to ask away. But I'm going to finish in the meantime with this quote, and I actually read this in, it was I read this in someone's character sketch, I think they call it. And ultimately it says you can't motivate people. You can only create a context in which people are motivated. And it's kind of almost stumped me, because I've always believed that I can motivate people. I've always believed I can help people to be a better version of themselves, to help people to ultimately get to where they deserve to be. But what I've come to realize is that I can only show you guys so much. I can only spend so much time with our members, with our grads. I can only do so much. But this is where Axia is quite special, okay? Axia is creating a context in which you can be, motivated every single day. Problem staring at the DOM all day. I'll talk about that in a sec. So what I want to just let you guys know is that because we're having streams every single day, all right, this is ultimately what keeps you motivated. If you've got to come in bang first thing in the morning and you've got to watch a technical stream, well, you might just pick on one or two trade strategies the traders are looking at. Ultimately, that's going to motivate you to watch those markets, to look in the right direction, to pay attention to the potential for opportunity. Equally, at the end of the day, you'll see various traders debrief. You'll see some debrief on the price ladder. I use Evernote a lot, right? That's an opportunity again for you to learn and be motivated as to the way that we are executing at Axia. And that's the key, guys. Axia is the context in which you can not just become motivated, but remain motivated. And that's the key. And that's why our members are thriving, okay? So have a real hard think about this. But yeah, to come back to your question, how to stare at the DOM all day. It's like anything, okay? If I said to you, go run a 10K now and you haven't run more than 2Ks in your life, you're going to be quite stiff. You're going to be quite sore. You're going to hate it. You're going to feel pretty sick, okay? Now, what I want to just say to you is that it's muscle memory. Right? I remember it took me probably 2-3 months to get used to staring at the ladder all day. Okay, so just teach your eyes. Okay, take a lot of breaks, but also teach your eyes to do focused attention. A lot of traders merely stare at the ladder. That's not enough. You've got to be playing a mental game in your mind, saying to yourself, okay, I can see a buyer absorbing, yeah, I can see a buyer absorbing, and now it's going bid, he's taking out a key level, constantly just engaging your thought. That's how you're going to learn to become better at the price ladder. But all it takes is time. Okay, so just stay committed and time. All right. Thank you very much. I appreciate that. So one question, the volume difference between spot and the futures. Okay, obviously the spot's going to have a lot more volume, right? But don't worry, and this, people keep asking me this. You don't need to worry about the volume being transacted in the thicker FX markets. Okay, if you're gonna cheapest data feed, okay, I'll get to that now. If you're gonna ultimately, become a trader, you don't need to worry in the majors. If you're trading any one of the major 6 or major 10 currency pairs, you're never gonna have a problem with liquidity. Okay, trust me. I trade quite a lot of sterling, and I can get quite a few contracts into that market without being, any kind of movement in the market. So just, don't worry too much about that, okay? The only advantage the spot will have, I'll say, is if you're trading some of the cross pairs, okay? If you're trading some exotics like, the euro against, the Chinese yuan, by all means, I'll say stick to the spot. You don't want to be trading that in the futures, okay? So it's all about liquidity. Don't worry about the overall volume transacted. Worry about the liquidity, okay? Okay, there was another question. Data feed. Okay, so as far as I understand, guys, one of the best methods if you're looking to get onto the ladder, okay, I would suggest as a non-pro, go on to, particularly the AMP. I think AMP has a fantastic model there. They really are allowing the retail space to really become better traders. You can pretty much get the Trading Technologies price ladder that I've shown you on the AMP. And you can, I think it's as much as if you want to trade CME, there's a CME bundle. Don't correct me if I'm wrong. I think it's $60 a month, and you can trade all CME products. So virtually $60 a month is all it costs you to be able to execute. Now, let's put this into perspective, because a lot of guys, I know, don't get me wrong, $60 is $60. It's a lot of money, okay? But $60 executing one central bank, like I've just shown you, on the smallest increment. If you take 10 pips, so you chicken out and you don't even execute it properly, and you take 10 ticks on a one lot, right, that's $100. Okay, you're going to pay for your data fee for 2 months in one trade strategy, just listening and learning various price strategies. Okay, so always, guys, when you look at cost, assess it in terms of what is the definable benefit. Okay, because I can guarantee you executing on a ladder has got far more opportunities and far more definable benefits than the cost is ever going to cost you. Okay, all right guys, thank you for joining. Feedback, send it to us. Any information, info@axiafutures.com. Otherwise, do log on to the website. Okay, one more question. What about not being able to see absorption if it occurs in the spot market and not in the futures market? Well, this is the thing, okay? Because the spot market is OTC, you're never going to see the absorption, okay? A spot market, by that very definition, is over the counter, okay? So you're not going to be able to see that absorption without a price ladder, and that's the key, right? Things like absorption or things like bid over or breakout strategies, you're not going to be able to learn to execute these effectively without a price ladder. Of course, you can use the traditional chart where you merely just buy at a level, right? But professional traders, don't just execute like that. We're watching the ladder and we're watching that shift in energy on the ladder, and that's what gives us edge, okay? The price ladder is one of the key edges that professional traders have. Okay, that's a wrap, guys. Thank you very much for joining, and I'll catch up with you guys again next week.